Hello and welcome to GP Bullhound's Technology Predictions 2023 webinar, which marks the release of our annual Technology Predictions report. In its 16th year, our report has established itself as an industry-leading analysis of the trends and innovations shaping the global technology sector. My name is Maria Lazareva. I'm with GP Bullhound's Insights team, and I am one of the co-authors of the report. I'll be hosting today's presentation, where we dive into the tech predictions shaping the upcoming year and look back at what we got right in 2022. From the GP Bullhound team, we are joined by partners Alec Daffner, Eric Crowley, and Kellerman Papp, Director Alan Cogan, and Vice President Okan Inaltai, who will walk us through the key findings of this year's report. To download the report, please visit gpbullhound.com/insights or simply follow us on Twitter or LinkedIn to get the latest news on our upcoming activities and releases. If you have any questions, please drop them in the Q&A box at the bottom of your screen. With that, I'm delighted to hand over to Alec Daffner to kick us off with an introduction to GP Bullhound and a review of how we fared with our 2022 predictions. Alec, over to you.
Thanks, Maria. Welcome, everybody. I'm Alec Daffner. I head up the San Francisco office for GP Bullhound. For those of you who aren't familiar with the firm, we thought we'd give you a little bit of a brief overview. As you can see on slide 5, it provides a brief snapshot of the firm, which was founded in 1999. We've completed over 640 transactions over that time period, delivering almost $40 billion in transaction value for our clients. We currently have over 180 professionals, including both our advisory and asset management teams. And our team is spread across 12 offices in both the US and Europe. Our investment funds currently have over $1 billion in assets under management. And if you flip to the next slide, you can see our core sector focus is on the technology sector broadly. Within that, we focus on software, digital media, digital commerce, fintech, and digital services are our core main subsectors. Slide 7 highlights some of our completed transactions in 2022. This includes both our advisory business and our investments. I won't go through all of them, but thought I'd highlight a few that are most relevant to our tech trends. In the ESG space, we've seen a lot of investor interest. In Q2, we advised EcoVadis on a $500 million raise. It was the largest tech private placement in France and the largest private placement in the ESG sector in Europe this year. GP Bullhound also invested in the company in a top-up round shortly after that. In social media and social commerce, we advised Pixley on their sale to ACC and Spring on their sale to Amaze Software. And in digital marketing, we advised Mechanism on their sale to Plus Company and CVC. We also advised Newcraft on their sale to WPP. In the enterprise software sector, we advised Unblue on their sale to Swisspost. We also advised Ecobot and Leadfeeder on their merger backed by Great Hill Partners. And ConnexOne, we raised $100 million. We also invested in that round as well as advised. Slide 8 just shows the team that we have that authored the report. And what I would say is it's truly a global effort. We canvass our entire team for feedback and input on the latest and greatest trends, gather those, iterate, and produce the report that we're authoring today. So really pleased to put this together. Before we dig into the tech trends for 2023, though, we wanted to provide a brief recap of 2022. And this is really our annual scorecard and how our predictions from the previous year panned out. We try to be honest in our assessment of how we fared. You can also see our scorecard, which goes back 10 years in the appendix of the report. So with that, maybe we'll just switch to the recap. And so our first prediction for 2022 was the creator economy. We got this one correct, as today's influencers are ushering in a new creator economy where they can create and monetize their own content. The number of creators globally has grown from 165 million in the past 2 years to over 300 million today. And the current creator economy market is estimated to be more than $100 billion globally. Trend 2, the rise of decentralized finance, or what we call DeFi. We got this one correct. There's no doubt that the collapse of some of the centralized finance platforms and exchanges like FTX and Celsius are setbacks for the industry, but DeFi protocols are still functioning smoothly. And this year we saw major financial institutions like JP Morgan execute their first DeFi transactions on public blockchains. Trend 3, technology is supercharging supply chains. We also got this one correct. From disruptions due to the pandemic to the war in Ukraine, the supply chain crisis continues to force businesses and governments worldwide to look at technology for solutions. Trend 4 was the arms race. The development and adoption of ARM chips has steadily grown, which confirmed our prediction. In Q1 of this year, ARM partners shipped over 7 billion ARM-based chips. That's up nearly 10% year on year. And Apple is also doubling down on its M series chip. Trend 5, the new virtual playground. We got this one correct, even though there have been mixed reviews of the metaverse, particularly in recent months. Apple has hinted through job listings that they're building a metaverse for their VR headsets, and Meta recently rolled out a new metaverse ID system. Trend 6, technology is driving diversity, equity, and inclusion, or DEI. We're definitely seeing more and more companies seeking technology alternatives to enhance their DEI recruiting initiatives, and we're seeing consolidation in the sector as a result. GP Bullhound advised Intello earlier this year on their sale to Silk Road Technologies. Trend 7, wearables powered by artificial intelligence. This was another correct prediction. Having passed the hype stage, wearables have entered what we call the plateau of productivity era, and we're seeing many new AI integrations in multiple verticals like healthcare, IoT, wellness, and psychology. The global semiconductor shortage, trend 8, with demand for semiconductors remaining high and little capacity build out, this will remain an issue for the foreseeable future, particularly since government initiatives to build out domestic capacity will take years. Trend 9, artificial intelligence is automating healthcare. This one we picked partially correct. While progress has been made, it's been slower than expected. Many legacy healthcare systems and healthcare institutions struggle to effectively integrate and deploy AI technology. And last but not least for 2022 was the future of payments. This was another partially correct prediction. While there has been continued demand for buy now, pay later models, high inflation and increasing interest rates have had a negative impact this year. So that concludes our recap for the 2022 predictions. Now I'd like to pass it over to Okan Inalte, a vice president in our San Francisco office, to kick off the 2023 trends.
Thanks, Oleg. Our first prediction is on natural language processing and artificial intelligence. Natural language processing, or NLP, allows software to fragment and process language like a human would. And today, it's much more widespread than you might realize. It runs on the back end of tools and applications we use daily, from automated customer service to smart speakers and voice assistants. There's an increasing focus on customer experience, automation, and high demand for big data and analytics, resulting in NLP adoption across all business verticals. Players in the artificial intelligence space have been working to raise capital in order to fuel their NLP development. For example, Jasper raised $125 million at a $1.5 billion valuation led by Insight Partners. And Grammarly raised $200 million at a $13 billion valuation led by Belly Gifford. Over the past couple of years, there has been a trend between tech giants racing to create a system with high levels of accuracy. 2022 has been another transformational year, with Google releasing their Pathways language model, or PaLM, which has 540 billion parameters, placing it above Microsoft and NVIDIA's Megatron, which has only 530 billion parameters. We also realize that more parameters do not necessarily imply a more reliable or better performing model, as Google's PaLM has fewer parameters compared to their older generalist language model, which had 1.2 trillion parameters, but Palm still outperformed it in 28 of the 29 mostly used NLP tasks in English. Looking toward the future, an area we think NLP can be disruptive is in government. Powerful NLP can allow governments to extract and categorize data faster, improve regulatory compliance, bolster national security, and analyze public feedback. Our second trend is on TikTok and its effect on the industry. Over the past 2 years, TikTok has taken the world by storm. As one of the largest platforms in the world, it has more than 1 billion users, representing nearly 20% of all internet users. TikTok's ability to supply endless and fast-playing content attracts consumers, while its reels are matching perfectly with the preferences of Gen Z demographic in particular. Early on, TikTok's creators realized that interests and buying behaviors aren't the same, even amongst the closest friends. So unlike other social media platforms, which are more connections-based, TikTok focused on curating content recommendations based on user interest and activity. This allows users of TikTok to discover relevant accounts more quickly and the creators to target specific hashtags, songs, or captions to increase their chances of going viral. Based on TikTok's unique algorithm, it's able to test a particular video's virality, allowing the platform to continue to scale. TikTok is changing the game for advertisers by allowing brands to gain actionable insights. It is slowly becoming the most attractive platform for advertising dollars. TikTok benefits from the fact that many users spend nearly about an hour on the platform daily, and brands often insert themselves into viral TikTok trends to convert attention into dollars. As TikTok's engine becomes even more precise, we believe that advertisers will increase their advertising budget allocations to TikTok, and TikTok will become a leader for many direct-to-consumer brands in the digital advertising space. With that, I'd like to pass it over to my San Francisco-based partner, Kelman Pop, to take us through the next 3 predictions in our report. Over to you, Kelman.
Thanks, Okan. Thanks for joining us today. The first prediction I'd like to talk about is the expansion of advertising streams. Now, with the streaming wars playing out over the past few years, it's no surprise that ad budgets are increasingly moving to CTV. Both Disney and Netflix have announced plans to deliver an ad-supported offering, and they've been backed by major DSP partners in The Trade Desk and Xandr, respectively. There are 2 major drivers towards CTV. One is that data is more readily available on CTV than in linear. If you watch a program on your CTV and you then go to the advertiser's website or even go into the advertiser's store physically, they can track that and even your purchase behavior. That's very powerful information for the advertiser. The second is just the following of eyeballs. With ratings falling year in, year out, it's becoming increasingly difficult to justify spend on linear. As one advertising executive recently put it in a conversation I had with him, the math is literally crumbling. The other topic that we saw within advertising streams is an increased focus on interactivity. Now, with younger generations having decreased attention spans for advertising, interactivity has become very important to the adverts themselves. We've seen popular methods of engaging users through polls, through games, and other interactive adverts. The flip side of this is that there's also a very strong push into programmatic. And so any ads that are delivered should be made programmatic accessible. And we think that there's going to be a lot of innovation around that trend to continue forward. The next trend I'd like to talk about is talent management. This follows the flow of the dislocation that COVID had over the employer-employee relationship. Today's employers are having to meet employees where they are. And what this means is flexible work solutions. Some employees want to be in an office engaging with their peers on a daily basis. Other employees want full work remote solutions. And then there's everything in between. Today's employers, if they want to attract top talent, are being forced to offer flexible solutions that can accommodate all of those needs. Moreover, we are seeing more and more HR solutions that are trying to put the employee at the center of their software. There's been a core focus around improving engagement and communication between the employer and the employee. These software solutions have shifted from recruiting-centric capabilities to retention-centric capabilities. Moreover, we're seeing an increased focus on software that allows the employee to focus on career development and job-specific training. Net, we anticipate going forward that you will see an increased focus around solutions that offer the employee better satisfaction within their job. The next trend that I'd like to talk about today is cybersecurity, and specifically zero trust. Zero trust is more of a philosophy than a technological trend. Zero trust is the basic principle that no user or access point can be trusted. This philosophy was dramatically exacerbated over COVID. With employees moving outside of the office and to the home, the employers had networks essentially became Swiss cheese. They had to protect vastly more access points, vastly more devices, and that became an extremely difficult problem for these enterprises. They're combating this problem through constant monitoring of the network and dynamic permissioning and rights. There's been developments in AI ML technology that will play an important role in proactively identifying these threats and quarantining unusual activity. Now, the flip side to that the industry is currently wrestling with is that you're increasingly generating false positives, which can be costly and time-consuming for the enterprise. As some activity on the network may appear to be malicious, it's actually in some cases very common and should not be the employee should not be frozen or locked out of their account. We anticipate going forward that the trends in cyber will continue to focus on protecting these additional access points that cause vulnerability in their networks to prevent extremely harmful break-ins going forward. With that, I'd like to turn it over to my colleague, Alan Kogan.
Thank you, gentlemen. Welcome, everybody. Our next tech trend is driven by a current events issue in 2022, which is seriously affecting Europe and Eastern Europe, the energy crisis. The cost of energy usage is materially impacting consumer pocketbooks, with November 2022 research indicating natural gas prices having increased over 100% in many European cities and electricity prices by nearly 70%. The cost of energy, along with inflationary impacts on many goods and services worldwide, are likely among the top 5 causes of the worldwide macroeconomic slowdown in 2022. Consequently, GP Bullhound's next tech trend prediction for 2023 is we expect a broader rollout of energy management applications to help consumers and businesses manage and optimize energy consumption. Additionally, we predict additional investment and development in new battery technologies, such as solid-state batteries, to facilitate clean energy capture and to support the rapid deployment of electric vehicles. The growing demand for energy-efficient devices is driven by consumers aiming to reduce energy output and secure cheaper gas and electrical bills. To some extent, this trend is not new to consumers, as products like the Nest thermostat more than a decade ago popularized energy efficiency through integrated sensors, mobile devices, and machine learning, wrapped in a beautiful consumer product interface. More recently, companies such as Tesla have also deployed their home energy capture and solar battery solutions with an attractive mobile app experience. Such energy management systems collect, measure, and analyze usage, providing optimized energy schedules that improve efficiency for homes and businesses. Research indicates that the market size for global home energy management systems will increase to $6 billion by 2027. One player in this space that we've highlighted in the 2023 Technology Predictions Report is Greenly, a provider of multiple smart energy saving solutions, including in-house consumption and electric vehicle charging capabilities. The company helps homes save up to 25% in electrical costs. Another innovative player, ShipShape.ai, offers a broad home energy analytics and maintenance service platform, like a check engine light for your home. By pairing home IoT monitoring for HVAC, hot water heaters, sump pumps, and other appliances, along with a home service provider marketplace, which can proactively be notified of upcoming home maintenance product problems, consumers will save time, energy, and money. As the current energy crisis unfolds, these type of comprehensive energy management solutions will roll out more broadly in 2023. Our next technology prediction is related to a topic that has been generating news headlines consistently for the last 20 years, climate change. While there has been some scientific and certainly political debate regarding the causes of climate change, it is safe to say that we have all experienced material shifts in, and specifically more extreme weather. It is hopeful to see a recognition of these patterns at global conferences, such as the very recent United Nations Climate Change COP27, and a growing multinational political movement to support our planet. Naturally, this issue has tremendous impact on the business landscape worldwide, as weather events such as flooding or heat waves severely disrupt productivity and or destroy critical infrastructure and assets. Yet, between or beyond political actions, GP Bullhound also sees a movement in the business community from entire industries down to individual companies to, one, self-regulate climate impacting operations, two, be transparent about these issues, three, help offset carbon footprints, and four, innovate with a new hardware and software technology to create safer, more sustainable products, solutions, and services. So our technology prediction for 2023 in this area is that the worldwide business community will significantly ramp its utilization and continue funding a variety of technologies that employ environmentally friendly practices to improve sustainability. We've seen this trend starting already, as climate tech funding represented more than a quarter of every venture capital dollar invested in 2022, making it quite a landmark year, according to the recent PwC State of Climate Tech report. The technologies and solutions stemming from these venture businesses will roll out more broadly in 2023. We expect to see this start with software technologies that help businesses with the self-regulation and transparency around climate impacting operations, specifically around measurement and benchmarking. For example, big data software analysis tools through the use of machine learning and AI can help manage supply chains, optimize energy usage, and monitor pollution emissions. Another example of business sustainability ratings, which help industries benchmark their performance against peers and drive improvements over the last decade. We've seen some tech giants such as Apple create their own rating systems for their products and transparently present those targets and results to the public. However, GP Bullhound also believes this benchmarking trend will extend beyond just products, but also to ratings related to operations across critical factors such as environmental impact, labor, human rights, ethics, and sustainable procurement practices. The importance of transparent supply chain assessments driven by real-time software reporting can be seen in our current events even, such as those at the Foxconn factories which produce Apple devices, where workers are protesting and delaying production due to salary payment delays and working conditions. Especially in the ecosystems that rely on offshore manufacturing or remote worker operations, business sustainability software will roll out in 2023 to help companies assess, select, and monitor their potential partners. Shifting gears here a bit, our rapid developments in the robotics arena, which is one of the most exciting trends we anticipate for 2023. Over the next decade, the market will grow tremendously for robots that augment or take over professional or consumer services tasks, such as agricultural applications, construction, cleaning, or meal delivery. However, in 2023, we predict the most significant robotics deployment acceleration in the commercial sector for industrial and manufacturing automation. There has been over $50 billion in VC funds invested in robotics over the last 5 years to build out various components of the engineering stack and to go over to hit the go-to-market evangelism. The vision and value proposition of robotics revolves around better productivity and lower costs for businesses, as well as better safety for humans. One of the best examples thus far of robotics deployments is in the warehouse and manufacturing automation, such as inside Amazon warehouses. Here, stationary robots help workers effortlessly lift extremely heavy items and packages onto mobile robots that then carry e-commerce items across the warehouse. Robotics innovators have recently developed collaborative robots, or cobots, which are robots that are smaller, less expensive, and easier to program. Historically, the penetration of cobots was hampered by a lack of sufficient accuracy, configurability, and safety to operate in industrial and service environments collaboratively with humans. Today's cobots are not yet replacing jobs, but they are enabling workers to do their jobs more efficiently, and they are generating significant interest in robotic startups. In 2023, we expect increased M&A activity, focused on companies that have successfully scaled their commercial deployments, as well as with innovators that have advanced edge controller components, efficient machine learning technologies, and AI for autonomous activities. I'd like to now pass the mic to another partner in our San Francisco office, Eric Crowley, who will take you through our final 2 tech trend predictions for 23. Eric?
Hi, everyone, and thanks for joining. Trend 9 is going to sound familiar, but we're pretty excited about it, which is the expansion of social e-commerce, and it's continuing to steal market share from traditional retail or legacy e-commerce. And what's going to push this trend in 2023 is the melding of 3 tailwinds. First, brands are trying to increase their direct-to-consumer sales away from Amazon and compete with low-cost international brands like Shine and Zara. 2, social media platforms like Facebook and Instagram are trying to find ways to monetize outside of pure advertising. And the third one, and the most important one, is consumers are increasingly spending their time engaging with social media and reducing their time spent with traditional TV, magazines, or God forbid, even a book. So, however, unlike e-commerce, social e-commerce is going to look very different across geographies and demographics. So in the Western world, live shopping historically has been associated with TV, primarily QVC. However, digital live shopping has exploded in China and India. So for example, last year on Singles Day in China, a streamer sold over $2 billion in lipstick in one day, and they're clear leaders in the live streaming space, led by Alibaba and JD.com, each doing billions in GMV annually. So Western brands and companies are rapidly trying to jump on the live streaming platform, and that's led by Instagram and Amazon. However, they're not truly dominant players yet. So the market is very much fragmented, open for entrance, and we're excited to see new players like Amaze, Live Shopper, Network, and whatnot enter that market. So one of our trends for 2023 is we're going to see increased M&A in the social e-commerce space as consolidation of both talent and technology, as well as marketplaces for the user starts to occur. So on to our last and final trend, which is trend 10, which is the continued acceleration of the semiconductor space. So let's flip to slide 10, prediction number 10. Okay. So the semis has been extremely volatile over the last 3 years. So in 2020, the world learned that extended supply chains can easily be disrupted, and production slowed of semiconductors slowed as the world plunged into a short and brief recession. However, as in 2021, as the world reopened, inventory of chips plummeted and demand skyrocketed as production remained very weak due to COVID disruptions. Consequently, pricing soared and the stock prices of the major chip manufacturers soared right along with them. However, so in 2022, stocks for those major chip manufacturers collapsed as excess capacity hit the market. We're starting to look into a recession potentially in 2023, and expenses for production, including primarily labor, expanded. and investors started to question the valuation. However, long-term in 2023 and beyond, we're going to see this as a really exciting sector here, where supply chains are going to continue to struggle to reset with COVID, and China's lockdowns and reopenings continue to be a hamper on the sector. So, however, countries, especially in the US, are starting to invest heavily in CapEx and tax subsidies to promote domestic manufacturing to protect their existing industries. Second, more and more devices, including AI and gaming services, are requiring high-performance chips. And then finally, chips are now, has quickly been realized as become an asset in global politics, with major powers actively promoting or protecting the industries. Perfect example of this is what you see what's happening with the US Chip Act. You've got Taiwan and China actively increasing subsidies to their domestic champions. And additional players like Japan are rapidly considering new subsidies for their manufacturers as well. So with that, I think that wraps up our trends for 2023.
Thank you very much, Eric, and thank you so much to all of our speakers today. We've received a few questions already, so we'll dive into those. The first question is, you mentioned the connected TV space as an area of M&A consolidation within the digital advertising space. What do you think is driving this? Alex, do you want to take that one?
Yeah, happy to dive in here. So I think streaming TV advertising presents really the best of both worlds for advertisers. On the one hand, you get the impact and effectiveness of video advertising. So think about your 15 to 30 second video spot on linear TV, combined with the measurement and attribution characteristics that you find in digital advertising. So we've seen massive growth in streaming TV consumption as a result of a broad range of new streaming services that have been launched over the past 2 to 3 years. In addition, many of those services received kind of big pandemic consumption bumps, which many have continued. And the pure subscription-based streaming services have introduced ad-based models. So it's interesting. Netflix had always been one player that kind of vowed that they would never introduce an ad-based pricing model, and they've done that just in the last few months. So we've been active in this space from a consolidation and investment standpoint. Bullhound advised BlazePoint Media on their sale to Denuity last year. We saw a significant amount of competitive interest in that process. We also advised a company called Channel Factory on an investment by Star Mountain Capital, and Channel Factory focuses primarily on YouTube, the majority of which is actually consumed by over-connected TVs. And they've seen tremendous growth over the past couple of years as advertisers seek to reach this audience really in a brand safe way.
Great. Thank you very much, Alex. Our next question is about TikTok. Do you think TikTok will become one of the main advertising channels for direct-to-consumer advertising in the next year? Oken, what's your take on that?
Thanks, Maria. Yeah, that's actually a very good question about kind of how soon we can expect to see advertising dollars shifting from other social media platforms into TikTok. TikTok landscape is ever-changing. Many businesses are still trying to figure out and understand how best to kind of effectively advertise on TikTok. TikTok also has a compounding effect on businesses that have traditionally not been staffed properly, quickly seize upon trends. However, in our observation, we've been noticing that businesses have already been tailoring their approach as to kind of react to TikTok's billion users on their platform, and the fact that these users are spending nearly about an hour on the platform every day. With all that being said, we expect to see TikTok to begin to rival Facebook and Google in the next 2 to 3 years, as we expect brands to shift ad spending to where the end consumers really are.
Thank you very much, Oken. Moving on to the next question, which is about robotics. What do you say to someone who believes cobots will threaten the working class job opportunities for real people? Alan, would you like to take that one?
Sure. I think it's a fair question, a good question. You know, by the very name, they are collaborative robots that are helping humans. These cobots are very efficient. They can help with ergonomics and really lifting the heaviest of items. So my view is that these robots will help with automation and speed up productivity, which for businesses is critical. It will improve revenue. It might decrease costs a bit, but really these are robots that are meant to make things more efficient. So with that, you know, I think they won't necessarily threaten jobs in the near term, or even long term, but they might actually expand the market opportunity and business in general for workers as well.
Great. Thank you very much, Alan. Next question. Will the emergence of zero trust philosophy and architecture be enough to completely prevent breaches or cyber attacks? Kellerman, what's your take on that one?
You know, look, in short, the answer is no. Cyber is a never-ending arms race. Bad actors and their methodologies are constantly evolving. Think of it as a game of whack-a-mole. So they'll continue to develop ways around zero trust and other cybersecurity capabilities. This makes cybersecurity actually a very compelling investment area, as it requires substantial R&D to stay one step ahead of those bad actors. That said, I do think that zero trust is a large step forward as a proactive, comprehensive mechanism for deterrence and resolution.
Great. Thank you very much, Kellerman. Moving on to our next question. Will the global redistribution of semiconductor expertise and production capacity create opportunities in previously overlooked markets and geographies? Eric, would you like to take that one?
Yeah, happy to take it, Maria. Yeah, my opinion is no. Chip manufacturing is extremely hard to do. It's very CapEx intensive and talent dependent. So it's hard for new countries to enter the race without an absolute enormous investment. So for example, you know, to produce chips, you need highly processed raw materials, and that includes high-end silicon. That's very hard to do without a really good and robust supply chain. Second, and in my opinion, more importantly, you need very highly specialized workers. These will both design and produce the chips. That talent's very expensive, and it's hard to train without existing workers to serve as an example. So what I think you'll see is duplication of supply chains among the major players, US, Taiwan, China. But I don't think you'll see a bunch of new countries or geographies enter the space.
Thank you, Eric. Our last question for today is about talent management. Will employers begin to lower salaries for employees if they introduce better work-life balance opportunities? Kellerman, what's your take on that?
Yeah, again, I'm going to say no. Look, it's no longer an either-or conversation where the employees must sacrifice work-life balance for higher pay or vice versa. There's been a real paradigm shift in the industry where both higher pay and better work-life balance come hand in hand. I think that employers are increasingly focused on obtaining and retaining the top talent. And they'll do that through a combination of both compensation and, you know, non-compensation related benefits. So going forward, I think that we'll continue to see, you know, both salaries increase, but also, you know, employers making a meaningful effort to provide their top employees with the best work-life balance that they can provide.
Thank you, Kellerman. This brings us to the end of today's session. Thank you very much to all of our speakers, and thank you for joining us today. For any questions relating to the predictions that we've spoken about today, please feel free to reach out to anyone on the GP Bullhound team, and we look forward to sharing more of our insights with you soon. Thank you, and have a lovely rest of the day.